In today's video, I'm going to be comparing two of the top Canadian dividend stocks you can own, Fortis and Enbridge. Both of these stocks offer high yields and are relatively safe investments to own, and they're both well-known Canadian companies. If you're looking for a stock to put into your TFSA, you may be considering both of them given their impressive track records over the years. In this video, I'm going to look over their financials, valuation, and what makes them good stocks, what makes them different from one another, and assess which one may be the better option to buy right now. So let's get started. First up, I'm going to talk about Fortis. Fortis is a top utility company in Canada, and right now it offers a fairly high dividend yield of 3.6%. And that's far higher than the S&P 500 average of less than 1.2% right now. So you're getting close to 3 times the average S&P 500 yield with Fortis' stock. But what's also appealing about Fortis is the relative stability and long-term growth it's been able to achieve over the years. If we look at both its revenue and operating income, both of those have been trending upwards over the past few years. You can see operating income 2.5 billion, 2.7 billion, 3.1, 3.3, and now 3.4 over the trailing 12 months. Meanwhile, revenue has been around 11.9 billion versus around 9.5 billion back in 2021. So it's been growing while also offering a fairly high dividend. And a big reason for that is that the company continues to invest in its growth, whether it's in Canada, the US, the Caribbean. There's a lot of opportunities for it to get bigger and reach more customers and steadily grow its business without taking on much risk. The company sees a lot of long-term growth opportunities, such as investing in renewable energy, supporting data centers, and even it's an underrated AI play, because when you consider all the investments tech companies are putting into AI and data centers, there's going to be an increased need for more reliable energy. And so that's an underrated opportunity for Fortis. And the company isn't shy about investing heavily. You can see it's allocated 26 billion in capital expenditures over the next few years up until 2029, and the bulk of that is being funded from cash it's generating from its day-to-day operations. And not only is the company investing in its growth, it's also focusing on giving back more to shareholders. It's planning to increase its dividend by around 4 to 6% over the next few years annually. And the company has already a terrific track record for dividend growth. For 51 consecutive years, it's increased its dividend. It has one of the longest streaks of all stocks on the TSX. So it's one of the safest stocks when it comes to paying a dividend, not only paying it, but also increasing it as well. And this is important, especially if you're a long-term investor. If your dividend is increasing around 4 to 6%, then that should be at a high enough rate where it offsets the impact of inflation. If you assume that inflation is going to rise by around 2 to 3%, then if Fortis is increasing its dividend by around 4 to 6%, then your real dividend income is increasing, and even after factoring in inflation, you're still coming out with a higher dividend than in the past. So that growing dividend is an important factor when you're looking at the long term. And when you look at the stock's payout ratio of around 72%, that supports the idea that there's plenty of room for the company to continue growing its dividend at a fairly reasonable rate. Another reason you may want to consider the stock is especially if you're a risk-averse investor. So Fortis has averaged a beta of 0.32 over the past 5 years. And what that tells you is that it doesn't move closely with the overall market. So if it mirrored the market, then its beta would be around 1.0. And so the lower that value is, the less it moves along with the markets. So if you want a stock that's not going to be as volatile as the S&P 500 or the overall markets, then Fortis is a great stock to consider for that reason. If we look at year to date, it's up around 13.5%, which is a bit better than how the markets have been doing this year. But if you look at a 5-year period, you're looking at gains of around 30%, which is a bit more modest. But as you can see, it's been steadily rising over the years. And this doesn't include its growing dividends. So there's a lot of incentive to hold on to Fortis, just because not only is it's stable, it's also growing at a modest but sustainable rate, and it's also increasing its dividends. So not only are you getting some great dividend income, some growing dividend income in one of the top dividend growth stocks on the TSX, but you're also benefiting from the company's investments into growing its operations and taking advantage of those opportunities, whether it's in AI or tech and renewable energy. So there's a lot of promise for Fortis to continue being a good long-term buy. And currently, its price to earnings ratio is around 20. So it's a reasonably priced stock that could still could still have a lot of upside over the long term. So there's definitely a lot to like about Fortis as a long-term dividend play. Now let's switch over to Enbridge. This is another top dividend stock, and its yield is actually higher than Fortis's. It pays 5.5% right now, and it's been higher in the past, over 6%. I remember seeing it over 7% at one point when investors were down on oil and gas stocks. But since Donald Trump has been elected and in office in the US, Enbridge and other oil and gas stocks have been rallying. Over the past year, the stock is up around 25%, which is a fairly good rate. And as you can see, now it's trading right around its 52-week high of around $69 a share. This is a much larger company than Fortis. Enbridge has a market cap of around $150 billion. And if we go back to Fortis, they're about $34 billion. So Enbridge is significantly higher. It's a much more well-known company in North America as well. It is, however, a bit more volatile. You can see its beta value is around 0.87, so that's higher than Fortis, which is around 0.3. And I think that's just more to do with the oil and gas industry as a whole, because as oil and gas stocks perform, so too is Enbridge, a bit to a lesser extent. It's a bit safer than your average oil and gas stock just because it relies more on long-term contracts, and so its operations aren't dependent on a high price of oil. In fact, one of the things that stands out to me is how good Enbridge has been at meeting its guidance over the years. When it wrapped up its 2024 results, that was the 19th consecutive year where it met its financial guidance. So if you think about just how often companies may adjust their guidance or downgrade their guidance when things are going bad, the company's actually met its guidance for 19 straight years. So that's a truly impressive track record, which underlines just how stable the business is, even despite all the volatility that people might expect from oil and gas stocks. And like Fortis, Enbridge is also continually investing in its growth. Back in 2023, it acquired 3 promising companies from Dominion Energy, which it referred as a once-in-a-generation opportunity to help grow its business, particularly in the US. This year, the company continues to do well with its adjusted EBITDA up 7% in its most recent quarter, and the company is on track to reach the upper end of its EBITDA guidance. And so it looks to be another strong year for the company to be on track to meet its goals. And like Fortis, this is another stock that could benefit from investments by tech companies into AI. You can see back in July, it announced a solar project to support Meta platforms and its data center operations. And this chart really helps to summarize its overall consistency over the past couple of decades. As you can see, despite financial crisis, commodity price collapses, forest fires, COVID, inflation, and global trade, its adjusted earnings and discounted cash flow per share have been rising, even despite all that instability in the overall markets. Enbridge has also been increasing its dividend for 30 consecutive years, averaging an increase of about 9% per year during that stretch. Although its track record may not be as long as Fortis's, it's also a top dividend growth stock on the TSX, and given its higher rate of increase, it may actually be a better one to own, especially when you consider its already high dividend yield today. Now, in terms of valuation, Enbridge's stock is currently trading out 24 times its trailing earnings. On a year-to-date basis, it's up 13%, and over the past 5 years, it's risen by 70%. So it's been a bit of a better buy over that stretch than Fortis has. So, which stock do you think is a better buy today? If I was looking at both of these stocks, if my priority is to keep my risk as low as possible, then I'd go with Fortis just because it has that low beta. It's not vulnerable to the potential volatility that comes with oil and gas stocks. Over the very long term, there's a bit more predictability in its long-term growth than there might be in oil and gas, where, as there's just shifts to different energy sources, that may not be the case. I mean, even though that may not happen anytime soon, that's always a risk with oil and gas. Is there going to be a shift to other energy sources in the future and diminishes the need for pipelines? However, I'd ultimately go with Enbridge just because it does have that higher yield. It still is a fairly safe play for an oil and gas stock, and it has the potential to do well, especially over the near term, just because even if you're worried about tariffs and that sort of thing, the one sector that the U.S. President Donald Trump has been fairly favorable on is oil and gas. And given how important of a role Enbridge plays in there, I think it should be on track to do to do fairly well, at least over the next few years. It's hard to say what's going to happen over a period of 20 or 30 years down the road, but for now, I'd go with Enbridge just because it does have that higher yield. It has been growing its dividend. It's a bit pricier than Fortis' stock, but I think its growth opportunities could be more significant, especially with the Canadian Prime Minister looking at potentially investing in more pipelines in Canada domestically and being a bit less reliant on the US. I think there will be opportunities potentially for Enbridge down the road. So I think it is a really good play, both in the short term and also the long term. So as long as you're okay with a bit more risk with Enbridge, I think it is the better overall stock. Especially if your priority is dividend. But overall, it's hard to go wrong with either one of these just because these are two of the best dividend growth stocks to own on the TSX. So let me know in the comments what you think and which stock you think is the better buy. And please make sure to leave a like and subscribe for more videos. Thanks for watching.